Jimmy Mbogo, KTN News, Nairobi.
All right, moving on to a story that is closely related to that. Now, the Kenya Kwanza government is very confident that the local debt market is able to finance over 80% of the fiscal deficit in the financial year 2023-2024. If the latest appetite for government paper is anything to go by, then the market will do anything for a higher return. But as Noah Kipkemboi reports, it will come at a cost that might see Kenyans and businesses unable to secure loans and banks opt to lend to government.
When Treasury issued a 7-year infrastructure bond, it purposed to raise a total of 60 billion shillings from the long-term paper.
Even this year, the government is targeted to borrow about 436 billion from the domestic market, the current financial year. They are short by more than 100 billion. They have not been able to achieve that. So what will happen is, if they don't get that domestically, then they might have to refer to external borrowing. The other option they have as a government is, you might have to then to review the programs you had planned to budget through borrowing. Either you scale them down or you push them to the next financial year. Because if you have no money, you can't implement it basically.
But the 15.8% return on the bond saw the bid triple the amount offered, hitting 220.5 billion shillings.
Well, indeed, 15% is eye-watering for a government bond, and it does crowd out the private sector, because that money that went for that paper could have gone to ordinary businesses and created jobs.
When you borrow domestically, obviously the interest rates are likely to be higher. And this is informed by the fact that if you look at now the inflation rate in this country, we had come down to 7.8, now we are back to above 8. And then time inflation goes up, as a way of managing inflation, interest rates will always go up. So what is going to happen is that with this high projection in terms of borrowing domestically, it is obvious that the government now will be competing with the private sector in terms of borrowing.
Of the total bids received, the government accepted 213.39 billion shillings.
Government is money hungry and cash strapped. You give them money, they take. And that's the reality of it.
Infrastructure bond target cannot be a moving target. It cannot shift. If we have pegged a target at 60 billion, then prudence requires that you can only uptake what you've planned to repay within a particular fiscal period.
It creates distrust, because it shows you are saying, yes, it's for infrastructure. You assume the infrastructure projects have already been mapped and have been costed, but you ended up taking up almost 3 times than what is hit. So it's lack of prudence.
This comes at a time the government intends to raise 530 billion shillings from the local market. Currently, Treasury bonds make 84.04% of government domestic debt worth 3.8 trillion shillings, with 45.25% of the domestic debt being held by banking institutions and 34.27% by pension funds. Noah Kipkemboi, KTN News.